Well, welcome to our final SwitzerTV investing show for 2021. And of course, a lot of people are on holidays, but someone who never sleeps, a bit like money, is Julia Lee from Berman Invest. And we catch up with Julia to talk about the market today. It could have easily been a big sell-off today, but it wasn't a big sell-off. We'll see why. We'll look at the stocks that fell today, see if there's some clues going forward, and we'll look at a number of other interesting stocks that Julia's done a bit of homework on. And then Paul Rickard and myself, we look at the lessons from 2020 and we look at the stocks that we'd like for 2021. Paul and I sort of chew the fat on this one to see whether there's some really interesting companies that have done reasonably well this year but might do a lot better as the reopening of the economy comes along and normalcy comes along as well, powered by the vaccine, of course. Some very interesting companies we've had a chat about, and I think you'll get some good ideas for 2021. Let's kick off with Julia Lee from Berman Invest. Well, joining me as she has for most of this year is Julia Lee. Thanks for coming on the program, Julia.
Great to be here, Pete.
Yeah, and I wish you a happy Christmas before we get to the end of it, because we'll probably be talking all the stocks, and I'm going to finish on Mesoblast. I have to talk about Mesoblast at the last one. But you've been a great contributor this year, and we really appreciate what you've done for us as well.
Thanks, Pete.
Okay, let's just kick off with today. The SPY futures indicator could have been a really bad day. Wasn't all that bad considering, was it?
It wasn't, and the big news that came out during our session was that the US had agreed on a stimulus deal, so a $900 billion package with maybe more to come down the line. So that really helped our market. At one point we were down 0.6%, but we ended the day virtually flat. In particular, those travel companies, it was a bit of a roller coaster ride given what we're seeing in Sydney at the moment with COVID-19 cases and lockdowns. So at one point, Flight Centre, Webjet, these type of companies were down about 6 or 7%, but by the end of the session, we were looking at a flat to 1% result. So it looks like on any sort of big moves downward, there was some buying coming through helping those travel stocks. But altogether, a pretty good session for the Aussie market given the leads from the US. And of course, watching the US tonight to see whether we do see any selling on the fact or the $900 billion stimulus package all being baked into the pie, or we do see some support coming through.
Either way, it's good to see the stimulus is actually coming. Whether the market is anticipating or not, you want that as an important plank or foundation for the US economy and then the stock market for 2021.
I think it is important, especially given the COVID-19 cases, which are spiking in the US at the moment, and the additional lockdown measures that we are seeing across the US. So that's a positive. And I think in terms of timing, it was a positive. The market was expecting it in the first 2 weeks of the new year. But the fact that we have seen it coming through before Christmas means that hopefully we will see that support coming through a little bit faster than anticipated.
Okay, let's get to our usual speed dating, Julia. Running through stocks, some have been sent to us, others I'm interested in. A company called Citadel, I don't know much about it. Do you know much about Citadel?
Yeah, Citadel, it is a company that was on the Australian market, but it's not on the Aussie share market anymore. That's because it was taken over. I think it was a $5.70 takeover price through a consortium which was led by Pacific Equity Partners. So that one's actually just been taken off the market. But, they were in the consulting space in IT, and they had big clients, federal government, state government, as well as the private sector. So look, that one, if you wanted to invest in it, it's a private company now owned by private equity. So unfortunately, that's not an option for most investors out there. Okay,
they missed the boat there. Let's go to A2 Milk. We know that another piece of bad news drove the share price down. I think, in our lifetimes together, you've occasionally said you've liked A2 Milk. A, do you still like it? And B, is there buying opportunity at this low price?
Yeah, I think I originally got into A2 Milk at 49.5 cents when it first went from New Zealand to listing here in Australia. So it was a fantastic ride, but at some point the market becomes a bit more mature and it becomes more difficult to grow. And certainly during COVID-19, A2 Milk has been impacted quite substantially by the Daegu market. You may have noticed that there's not a lot of international students here in Australia at the moment. So that channel has been impacted, and that also impacts the sales going into China as well as the Hong Kong sales channel. So unfortunately, that's been a negative. We've seen 2 profit downgrades coming through for A2 Milk. I always say that things usually come in threes. So, there is the risk of another downgrade there. The other thing that we're watching is a new CEO starts next year. And I think A2 Milk really does need a bit of a shift in terms of direction to try and regain that growth. So look, it's not the easy money spinner that it used to be. I think that there is substantial risk that we could see another earnings downgrade there. So look, I'd be a little bit cautious. Usually I wait to see signs of recovery before jumping back into things like this.
Yeah. Good hint, good tip. Let's go to one called Australian Strategic Materials. What do you reckon?
I think this is in the rare earth space, and Pete, I like rare earths, and my preference here is for Linus, or if you're trying to play the electric vehicle story through something, through nickel is another way to play it, and we're also in Independence IGO. Australian Strategic Minerals, I guess you're having a look at something that's still in development, so they're developing the Dubbo project, I believe. But I prefer something that's already producing at the moment, given that we will probably see more mines coming online as electric vehicle story gains traction. I guess the demand for electric vehicles comes from 3 key sources. One is electric vehicles, which is going to be a key driver. The other is wind turbines, and that's been actually growing quite strongly as renewable resources are very much in focus around the globe. And the third area is the area of military as well as aerospace. So look, I think the outlook for rare earths is very positive. I prefer to be in a producer like Linus, but as long as the rare earth price is going up, which I think it will be in 2021, I think ASM should do well as well. Okay,
let's go to a company called Lifestyle Communities. It sounds like a charity group, doesn't it?
Look, this one is all about riding that structural trend of an aging population. So this is for, I guess it's a community village for over 50s, and what you do is you buy a house there, but you don't buy the land, you lease the land. So you pay anything from, I think, around about $100 to around about $220 a week for leasing the land, so the site costs, and that's how Lifestyle Investment Communities makes money, all through the land as well as through selling the houses. So they constantly have new sites where they're developing. So I guess this one is a play not only on the aging demographic here in Australia, but also property prices, because obviously you're going to be able to get a higher price for those houses if property prices are moving upwards. And property prices are looking fairly good at the moment. And Lifestyle Communities, the share price is actually 30% higher than where it started off the year. So it has been gaining traction, and part of it is the development plans, the villages that are coming online, as well as the strong sales there. So look, I like this one here. I'd be keeping a close eye on the property price, because that's one thing that tends to move around and impact on a company like this. But the outlook for property prices at the moment looking pretty good. Yeah,
I know even Macquarie has got into those sorts of lifestyle community type projects. I think the people actually do own the land and the buildings, but you're right, but there's a whole lot of extra value that they get out of it. And I think it is a way of the future in many ways. Look at the demographic of people who are looking for sort of support as they get older. So I think you're on a good one there. And what about Point Terra, 3DP?
So this one's actually been included in the tech index. And it's an interesting one. This is all about data. So companies holding their data with 3DP and then even using them in sometimes just for analytics as well as processing of the data as well. So look, I think this is an interesting area. I think it is a strong growth area. They look like they're about to break even, which is pretty exciting, although they are a relatively big company as well. We know with tech companies like this, a lot of the sentiment does stem from the US, in particular the NASDAQ. So watching how big tech does, because it does impact on pricing as well as sentiment. But I think the outlook for data companies like this is looking bright. It is a smaller type of company that is about to break even. So look, I don't mind it here, but I probably prefer it at a cheaper price. It does look like it is due for a bit of a pullback. And if it was to pull back around about 10-15%, I'd be buying it there. The other thing is that it has some big names backing this one. So you've got Bevan Slattery, who's a big holder there and involved in that. And of course, he's got a great track record with things like NextDC as well as Megaports. So an interesting one, but I think it's relatively immature and the growth is still ahead of it. So yeah, I wouldn't mind this one. Probably a little bit higher risk given the volatility we've seen in the tech space.
Yeah, well, I think in the past you've liked Megaport. I interviewed Bevan about 2 or 3 weeks ago, which made me more committed to Megaport. Had a nice rise on Friday. Is it a company you still like, Megaport?
Yeah, I still like it. As I mentioned, Pete, when it was $13, I really liked it around that price. And the thing with the tech companies at the moment is that it is very volatile. It's not volatile because there's been massive changes in terms of the earnings outlook or the growth outlook. It's been mostly sentiment and the rotation that we've seen away from tech and into values. So look, I think tech will come back into focus once that value play and that rotation has played out. But it's a great chance to bag a bargain if you still believe in the sector and the growth, which hasn't disappeared by any means. It's just that investors have a lot more investment choices, given that they're interested in things like travel companies, hospitality, as the focus on vaccine rollout comes into play.
Okay, one last one, and it's one that you and I have tossed around all year, Mesoblast. It was blasted again on Friday.
Yes.
And the interesting thing I found was that when I focused on Mesoblast, and a lot of us come from your tutoring, that there's 3 big areas that have potential over time. And I didn't really worry about its COVID-related activities, but clearly the market did. Tell us what you think. What do you think about all this?
Well, firstly, Pete, I was wrong on this one and I wish I could be right on all of them. But I guess what attracted me to Mesoblast is the number of catalysts in a 3-month period. For a lot of biotech companies, they spend years and years on doing these phase 1, phase 2s, and getting finally to phase 3 and potential commercialization is an important and an exciting inflection point. So looking at Mesoblast, there were 3 key possible catalysts. Phase 3 in terms of graft versus host, phase 3 in terms of lower back pain, and phase 3 in terms of chronic heart disease. And then there was the COVID-19, which was an extra that was thrown in. So you could say there were 4 key catalysts within a matter of 3 months. Unfortunately, 3 out of those 4, it's been a pretty bad negative time. So there's only one more left, and that's lower back pain. So you'd have to say that the risks here have increased, not so much because the Mesoblast product are not working, because some of the results have actually been interesting, but probably more a design of the way they've designed their trials. And I guess they didn't know going into it what would be the positive and then the negatives coming out of the trials. So look, in terms of the chronic heart pain, I think they still have a product there, but maybe another phase 3 to go, given that they didn't reach their primary endpoint, but the secondary endpoints were pretty exciting. There was a 60% decrease in the number of heart attacks and stroke. And in the class 2 patients, which was about 200 out of the 500 patients enrolled, there was also a 60% fall in deaths as well. Unfortunately, they didn't reach their primary endpoint, which means they probably have to redesign the trial. So it just means commercialization has been put out a bit. I guess for investors that are in this at the moment or looking at Mesoblast, the key question to ask at this very difficult time is all the bad news out there, or is there more bad news to come? So the next catalyst is, I think, the lower back pain, which is due in the first quarter of next year. And then the question mark is on whether we start to see better news coming out after that. I guess most of the bad news for me is out of the way. The only thing that sort of that keeps me from being really positive on Mesoblast at this point is that, you know, phase 3 trials do take a long time to get through, and there's potentially an extra phase 3 for the graft versus host and an extra phase 3 now for the chronic heart failure. So look, I think this is going to look like a pretty exciting company in 5 years' time, but in the short term, I think there's a bit more pain to come here.
Yeah, so people who expect to invest now and see a return in 2021, they could be disappointed. But it still has a lot of substantial products that could actually be very good.
Yeah, I think, well, for me, the probability was, you know, with 4 key catalysts out there that, you know, the probability was that, you know, Mesoblast for me would have had a good time. But unfortunately, I've been wrong there, and 3 out of 4 have turned out to be negative catalysts. We're still waiting on one more catalyst there for Mesoblast, and really the commercialization has been increased, and you'd have to add on another 1 to 3 years for commercialization of some of those products.
Okay, Julia. Now, thanks very much for all your contributions, and I look forward to catching up with you in the new year. Have a great break.
Merry Christmas, Pete.
Hi, I'm Peter Switzer, founder of the Switzer Report. And if you're looking to build your wealth, my Switzer Report has everything you need, and so I'm inviting you to come and invest in stocks with me. At the Switzer Report, we provide you with expert guidance and actionable advice for managing and growing your wealth from some of the brightest stock pickers and investing minds in the country. And so I've got some great news. For the next 2 months, we have a fantastic Christmas and New Year offer that I would like to tell you about. If you take up a Switzer Report subscription across the months of December and January, not only will you get all the usual inclusions to the report, but you also will get the following. Exclusive one-off webinar with myself and Paul Rickard, where we will show you the hot stocks we picked in 2020, and we'll also give you the stocks we are picking for 2021. You'll receive a free copy of my book, Join the Rich Club, valued at $24.95. And you'll also receive a free ebook with our best investment ideas for 2021. Sign up today and receive 3 newsletters each week delivered direct to your inbox on Mondays, Thursdays and Saturdays, with analysis from our experts including myself, Paul Rickard, Tony Featherston and James Dunn, and others such as Julia Lee, Junbei Liu and Rudy Philippek van Dyke. Your questions can be answered in the Q&A forum, where you can submit an investing question and receive a guaranteed response from Paul Rickard. Monthly webinars with myself and Paul Rickard, and special guests who will answer your questions live. You'll receive complimentary tickets to our events for you and a guest, including our annual Switzer Income Conference, the Switzer Investment Strategy Day, the Switzer Listed Investment Conference, and the Switzer Small and Microcap Investor Day. You'll also have access to our weekly Boom Doom Zoom interactive TV webinar, which are stock assessing sessions between Paul, myself and subscribers. You'll be able to view our income and growth model portfolios designed and updated each month by Paul Rickard, and you can browse the archives containing thousands of archives and resources about specific shares, the markets, SMSFs and more. Information and insights from people who live and breathe stocks 24/7 increases your chances of making some real money on the market. I really want to share with you all the insights I get access to that most investors are never lucky enough to see or hear. Come invest with me using my Switzer Report. Follow the link in the description of this episode or visit www.switzerreport.com.au to sign up for your Christmas New Year offer and join me on the journey of financial knowledge and wealth, where I will be able to call you one of my valued Switzer Report subscribers. Well, this is our last show of the year, and so I wanted my colleague Paul Rickard to sit down and have a look at some of the stocks I want to buy. Well, I'm actually holding nearly all these stocks, but I think they're good. I'm buying more whenever they sell off. but I want to see what he thinks of them and what he likes for 2021. Paul, are there a couple of stocks that you have bought recently which you're expecting them to do well in 2021, and that's why you bought them, because you think the price is attractive?
Yeah, look, I mean, the price is probably pretty high, Peter, but I think JB Hi-Fi is going to do really well in 2021. That's been a favourite of mine for a long time.
It kicked back a couple of weeks ago, then came back.
Yeah, it got up to about $52, $53, Peter, in early October, then went back to the low 40s, which as we saw a whole lot of movement to some other stocks as part of the rotation trade. Now back up to $48, so I think that was really good buying in the low 40s, about $44.
If you saw it there again, would you say goodbye?
Yeah, I mean, I think it's still value there. I mean, I just think it's a great company and not a lot of risk. Yeah. So it's one of the, I'm quite happy to make 10% or 15% of stock and not have to risk, 50% to do so.
Yeah.
So I think it's in that category. Wesfarmers, I think, is in the same category, Peter, although it's in the 50s now, so they're getting pretty expensive. I think there's a couple in the tech space. We've talked about NextDC in this program on several occasions. There's a couple of others in that category that have been valuable, have shown some value. A2 Milk was one I was banking on. I didn't quite see the write-down coming on Friday, but I think that's starting to look fairly attractive again.
Yeah. Yeah, and what about TWE? Have you shown any interest in that?
I did show some interest in TWE, Peter. I missed it. I think when we talked about it a couple of weeks ago, about $9, that was a time to buy it. Hasn't got back down there again. So, look, that's really for the bottom drawer because, I think the whole thing with China is going to go on for some time.
Yeah, at least a year.
But TWE's got its own brand value. It'll be valuable. It'll reach a bottom, or has reached a bottom, I think, that someone else will look at the business. So I think that it's one of those stocks that there is limited downside simply because it has such terrific assets that at some value, whether China stops or the whole world stops buying wine, someone will say this is just too good an asset that I need to own it.
Is A2 Milk's problem also because there is no Chinese trade to Australia, and a lot of the travellers would buy the stuff and take it home as the Diageo trade, isn't it, Paul?
Yeah, look, it's a bit of a problem. It's doing very well in the so-called mother and baby stores. Now, it's in about 18,000. We probably refer to them like the bub stores.
Yeah.
Not bubs.
Only 18,000.
And that's only about a 30% representation. So it's doing very well in sort of what it sells directly to the Chinese consumer. What has been impacted, obviously, is the Diageo market. So that's students coming into Australia and others shipping back to into China.
To their families. Yeah.
But also on the cross-border, on the e-commerce sites. So there's been some challenges there, and they've found that there's been a replication of some of the issues with the Diageo trade impacting the cross-border sites. So the WeChats and those type of sites which people buy goods on. So doing well in the stores, not doing so well in the other areas. And I guess it's we're all sort of hoping that that really now we've got the bottom. I mean, I think you could probably say, looking back in A2 Milk, they've been this is effectively the third downgrade, Peter. Things come in threes. Also, a lot of the directors and managers sold out straight after the results. Told us, I guess, back in late August, there was a bit of criticism. There was a bit of not insider selling, but managers and directors lightening their positions, and that got some feedback. So I guess the stuff has been there to show us that things weren't travelling as well as we expected. Let's hope all the bad news is out and it goes back to what it is. It's a really great marketing company, and it can deliver on what it now provides as guidance for this year.
Okay, well, I looked at the Switzer report today, a number of stocks that I like for next year. And if people want to know more, they actually should take out a subscription to the Switzer report. I want to quickly just run through a few with you. One in particular I've liked following an interview I did with the founder and CEO, Danny Lewisham, and that's Elmo Software. And I think in recent weeks you've shown a bit of interest in it as well. I don't usually influence you very much, but
we have on this one, Peter. That's because I got quite interested in Elmo, and they've just done an acquisition, another one in the UK. When I wrote about it, Peter, it was about $6.20. It dropped down sort of a couple of weeks ago to about $5.80. They've done this acquisition; it's now back at about $6.60. I think it's a great little company. Just sort of. I guess you've got a big base developing in the UK, or a big base that's all relative, and the Australian market running the two side by side, whether they can actually bring some of the stuff they're buying in the UK back to the Australian market. But look, they were also been impacted by COVID-19, as we know, because we know when companies cut back, some of the so-called modules that they're selling for, not just payroll, but in terms of how you manage your HR, people put off what will almost be discretionary spending. Yeah,
and JobKeeper is in the HR space, isn't
and
it?
JobKeeper's in the HR space. So it's all types of, I think they've got about 14 different modules, and at the moment they've got, the average new client buys about 3.4 or something, and the job is to actually how you upsell and get them to take on more modules.
And that's their future, isn't it?
And that's their future. And I think they've done a pretty good job. So on not a lot of capital spend. They're pretty well cashed up, Peter, cash at bank. And it's because it's all, the software should be pretty scalable. So I think a good little business, and that's ELO.
Okay. You can't talk about Tyro because you're on the board, but both Tyro and EML payments I like because I think they're just classic. They're going to benefit the more we reopen. I guess the current problem in New South Wales is not going to be good in the short term, but I am talking about 2021 as we approach normalcy. I think Tyro is a company that's linked to the hospitality sector, and that's part of the reason why I like it. But EML payments, I must admit, I've been hearing so many ads on radio and television about shopping cards and stuff like that, and because people get this online nowadays, and EML plays in that sort of shopping centre gift card space, doesn't it?
Well, it's big in the gift card market, not just here in Australia, but also in the US, and it's been showing good growth, and a lot of people rate that company pretty highly.
So that's one that I think once again will benefit when normalcy comes. It might take 6 months to a year, but because of that, and I love the bounce. All these companies I've talked about have all bounced well out of the coronavirus. So they'll belt it up on the way down, but they bounce nicely out of it. Let's go to a company called, these are travel ones. I think these ones, Webjet, Corporate Travel, Qantas and Flight Centre, they're all good quality companies, and they're going to benefit the more we get to normalcy. Am I taking too many risks?
Look, I don't think you are, Peter. I mean, you and I have argued about the travel companies for the last few months.
And your caution was probably right.
Well, I said I always preferred Qantas. I just thought that was the purer play. I think Qantas is unquestionably going to be a big winner at some stage.
Yeah.
And the others probably, Qantas is only about 30% off from where it was pre-COVID, whereas the others they've bounced a long way, but they've got a long way to go back still.
Well, I think Webjet was around $12 or $13, and I think it's around $5, and it was down about $2 or even less. So it's had a massive bounce, but it's going to need a worldwide return to normalcy. If that happens, I think $12 again will be a possibility. And one thing I think you've picked up, and I've picked up, a lot of these CEOs are saying the coronavirus has made them cut in their costs like never before. So the actual profit bounce might be a bit bigger and a bit quicker than we think.
Well, I think that's very much the case that Qantas has demonstrated. I mean, because it's doing a lot of changes to its workforce in terms of how it employs people, and and there are going to be some pretty big fares out there because people, are just going to get used to paying. There's not going to be as much competition in the travel industry. There won't, simply because of the changes that have happened, and I think going into, if not this year, 2021, Qantas is going to do pretty well. Now you have to be patient with these companies because the market's probably going to be 6 to 9 months ahead of the actual earnings. And the time to buy them is before any of this thing starts to pick up. So my caution on the travel companies, Peter, is whether a lot of the bounce has already happened. I still think Qantas has got further to go. The others, I think the jury's just going to take a little longer to really know how to play some of these companies.
I'm seriously for Webjet, Corporate Travel and Flight Centre. I'll be happy if I get another bounce inside the next year, but I'm kind of playing the 2 years. I think 2 years normalcy is over. I know personally a couple who my wife and I go holidaying with. We caught up recently, and we're planning to go in September. That might be cancelled because coronavirus. But we're desperate to go travelling.
I think a lot of people are desperate.
I'm sure you are as well.
But I'd like to go in March, Peter, but I don't think I am. So now thinking about June. But Yeah, it's going to be a lot of people like that, and I think one of the issues that's coming out with particularly the airlines is just the time it's going to take to retrain people.
Yeah.
And that could be an issue, but there's going to be demand, and we've seen in the domestic travel, we've seen how quickly people have responded to, before the New South Wales issue re-emerged, we saw just quickly how the demand soared there for flights to the Gold Coast and to Queensland and down to Melbourne and vice versa. So there's a lot of demand there.
But one last thing before we get off the travel stocks, something that developed in 2020 is Zoom. Now, is Zoom going to affect the business travel interstate, particularly Sydney to Melbourne, Paul?
Well, it'll be interesting to see just how the sort of typical, big companies who have lots of operations in Melbourne and Sydney and vice versa now manage staff across multiple geographies and how much travel they need to do, which most of the time is actually not seeing customers, it's actually dealing with staff, right?
Yeah.
That's what most business meetings are about.
Yeah.
So, look, I think Zoom is good, but there's a limitation. I think it's going to take a little while for the corporate market to fully respond. But I guess that we're also going to see less competition because at least domestically, Virgin's going to won't be just competing for the business traveller. There's going to be a lot fewer flights on the route because it's all going to be about profit maximisation.
Yeah.
And I guess Qantas is going to be making some pretty good margins. So I don't know. What do you think of business travel? Do you think we'll all just get straight back into that? Or
Well, I think what will happen, Paul, is where once upon a time you might have done a business. I'll give you a classic example. In our own business, I would send our financial planner down to Melbourne to talk to our Melbourne clients in our office in Melbourne. But now that could be done on Zoom because we've been doing Zoom this year. But if it came to a new contract or or signing up a new client, I'd want my guy to go and see them face to face, eyeball to eyeball. I think major deals will travel for just things that may well have been transitory or not that important. They'll be cut out, and Zoom will be used. But at the same time, as you pointed out, costs are going to be cut out of these airlines. So I think the profit implications could be quite small.
Yeah. I mean, you remember technology is different, but you go back into the late 80s when we had the pilot strike and there was no travel in Australia domestically for 6 months, was it?
Yeah, basically.
Yeah, the pilot strike. And of course, we all said people would they got used to using a telephone, right?
Yeah.
We had a thing called a conference call.
Conference call, yeah.
Conference call, right? Yeah. New technology. And there's a lot of talk about that replacing how when the airline travel returned, people would just be happy with the conference call. It didn't last that long, so I still think that despite we'll use the technology for some things, Peter, there's nothing. It's still much easier to talk to someone in the flesh. And to be honest, I think most executives actually enjoy a bit of travel, right?
Yeah.
I mean, they don't like too much, but it can become tedious, but it's still a change to routine.
Yeah, and I think you get more out of a face-to-face meeting than a Zoom meeting, and that can often lead to more ideas and better business. Paul, Megaport, I like it. I like Bevan Slattery. I like next week. We have covered Megaport.
We have.
Yeah, and so but one final one, and this is like a blast from the past, Mesoblast. This is really for the thrill seekers, and I've got to say, historically, I have not been a thrill seeker investor. I bought in around $3.10 or $3.20 when it sold off, and now it's gone down to $2. I've bought again. I've dollar cost average in, but I don't know when I'm going to make some money out of this. But I think it's an interesting company.
Yeah, it is an interesting company, Peter. I mean, I was a little disappointed with their last statement because I'd read that a lot of this stuff was sort of, almost like a foregone conclusion, a lot of these things, right? And you have to read it carefully to realise, no, this trial's been abandoned and nothing's going to happen. So I guess that's the challenge of investing in a biotech. It's a bit like investing in an exploration company. A lot of companies try hard, have lots of promise, and not that many make it. And I guess that's what reminds you. I thought this company was stronger and had multiple areas of where it could come good. So look, it's for the speculative part. I mean, I guess it depends on your portfolio. If you made a lot of money and you've got good portfolio stocks, by all means, have a little punt, because it's not going to be the end of the world if it goes wrong.
That's
but
right.
You don't want to risk your life savings on a company like this.
No.
But stay close, stay nimble, And if you work out it's the wrong thing, then just kill it and move on.
Well, historically, most of my investments have been in the core, and it's only because of the March 23 sell-off I saw so much value in interesting companies. I've increased the satellites, the speculative ones, the ones that might give alpha. But yeah, Mesoblast falls in that category.
And I think the market's certainly changed a little bit here, Peter, is that you're almost forced to be a little bit of a momentum player in some ways.
Yeah.
Now, whether that's because there's just too much trading going on, too much short-termism, too many people convinced that the long-term trend is up, so you really don't have to worry too much about your portfolio stocks, and we can all get onto a bit of the momentum. But it's certainly making you really think, because if you're not a momentum player, it's hard out there, right?
Yeah.
Because something can just sit there cheap and be cheap there for months, if not years, and it's hard work being you're investing in something and seeing it going sideways or nowhere when the rest of the market's going up.
One last thing before we finish up. I think for those people who don't want to go into speculative companies, I think there was a really powerful lesson in 2021. And it is in an area where you and I remain solid, and that was with the banks. And so you look at a company like CBA, which you and I always said was the best bank, and we often went for other ones for more value because they were priced at a lower point. But I think CBA definitely went under 60 this year and is now over 80. So if you can make $20 on 60, that's 33% with a quality company. It underlines that strategy. When a quality company gets beaten up by the market, it's a good time to buy.
I mean, that was one of the big lessons. That when the market's in free fall, everything goes down, right?
Yeah.
But that's because you've just got there's so little liquidity that some people have to sell and there's no buyers. So we saw that on March 23 or March 22 and March 23 and all those days around there. But the best companies recover first and hardest, and that's what happened to CBA. It's clearly the best bank, and it didn't go quite down as far, but it was the first to recover. Yeah. And we saw that in other examples. So now when the market matures, people move on, but they're not throwing out their CBA. It may not be going up quite as fast. So I think there's a lot of companies in that same category, Pete.
Yeah. I think Warren Buffett once said, when it's raining gold coins, get as big as bucket as you can find.
That's one of Warren's great sayings.
Okay, that's Paul Rickard from the Switzer Report, and thanks for joining us and good investing in 2021. Hi, I'm Peter Switzer, founder of the Switzer Report. And if you're looking to build your wealth, my Switzer Report has everything you need. And so I'm inviting you to come and invest in stocks with me. At the Switzer Report, we provide you with expert guidance and actionable advice for managing and growing your wealth from some of the brightest stock pickers and investing minds in the country. And so I've got some great news. For the next 2 months, we have a fantastic Christmas and New Year offer that I would like to tell you about. If you take up a Switzer Report subscription across the months of December and January, not only will you get all the usual inclusions to the report, but you also will get the following. Exclusive one-off webinar with myself and Paul Rickard, where we will show you the hot stocks we picked in 2020, and we'll also give you the stocks we are picking for 2021. You'll receive a free copy of my book, Join the Rich Club, valued at $24.95. And you'll also receive a free ebook with our best investment ideas for 2021. Sign up today and receive 3 newsletters each week delivered direct to your inbox on Mondays, Thursdays and Saturdays, with analysis from our experts including myself, Paul Rickard, Tony Featherston and James Dunn, and others such as Julia Lee, Junbei Liu and Rudy Philippek Van Dyke. Your questions can be answered in the Q&A forum, where you can submit an investing question and receive a guaranteed response from Paul Rickard. Monthly webinars with myself and Paul Rickard and special guests who will answer your questions live. You receive complimentary tickets to our events for you and a guest, including our annual Switzer Income Conference, the Switzer Investment Strategy Day, the Switzer Listed Investment Conference and the Switzer Small and Micro Cap Investor Day. You'll also have access to our weekly Boom Doom Zoom interactive TV webinar, which are stock assessing sessions between Paul, myself and subscribers. You'll be able to view our income and growth model portfolios designed and updated each month by Paul Rickard, and you can browse the archives containing thousands of archives and resources about specific shares, the markets, SMSFs and more. Information and insights from people who live and breathe stocks 24/7 increases your chances of making some real money on the market. I really want to share with you all the insights I get access to that most investors are never lucky enough to see or hear. Come invest with me using my Switzer report. Follow the link in the description of this episode or visit www.switzerreport.com.au to sign up for your Christmas New Year offer and join me on the journey of financial knowledge and wealth, where I will be able to call you one of my valued Switzer Report subscribers.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.